Welcome to the Techno Fundamental Report for November the 16th. William O'Neill first started learning about William O'Neill's strategies back in 1982. Let's look at them real quick. Letting losses run is the most serious mistake made by most investors. You don't want to allow to get a 50% loss in something because then the stock has to go back up 100% to get your money back. Don't let losses run. Second, the stock market is not random because strong investor emotions can create trends. So it's not random. It's an auction process, and there's millions of investors out there, hundreds of millions, that determine the auction market process. So it through this process, you do see trends. So the trends are your friend. If you own a portfolio of stocks, you must learn to sell the worst performers first, keep the best a little longer. So in other words, trim you're not going to, Peter Lynch said you can hit 6 out of 10. You're not going to hit 9 out of 10. And that's in a bull market. So if you have bad performers in your portfolio, you need to weed the garden. It is one of the great paradoxes of the stock market that what seems too high usually goes higher, and what seems too low usually goes lower. So in other words, what he's saying is that it's buy high, sell higher. It's not buy low, sell high. If something's low, it's low for a reason. It's usually because the company's in trouble. Next and last but not least, he says, I think there's a certain amount of humility with top traders. You have to make enough mistakes and learn to overcome them. I would say out of the last 48 years, the most important thing I have learned is humility. The market is difficult. It's never going to go the way you think it should. And so you really have to work hard on learning strategies so that you can overcome these problems. Now, I wanted to mention Carl Icahn. He's an interesting man. He's a corporate raider. And he basically would say, he says, if your company isn't growing, it's dying. So you've got to have growth. You've got to have management teams in there. Now, he never would hire a CEO that had a low golf handicap. He kind of felt that they weren't as committed to the company as he would like. So if you look at a situation like Elon Musk, this is the recent book by Walter Isaacson. Good book. I'd recommend it highly. The problem with Musk is he's too committed. I mean, he is very difficult to work for. But anyway, his latest project is working on a robo-taxi concept. It's very interesting. This is a three-wheeler, 2 seats, all electric, all autonomous, no steering wheel, nothing, anything. Now, this is all about artificial intelligence. This is a fund here, the Wisdom Tree Artificial Intelligence and Innovation Fund. And you can kind of see here it's breaking out above the moving averages. I think this artificial intelligence is going to be one of the biggest areas, according to certain people, that robo-taxis are going to be a reality someday. Now, I wanted to mention here a report came out saying that inflation will hit the Fed's 2% target by April and keep falling, analysts say. Inflation is poised to hit the Fed's long-term 2% target by April. Now, we're going to talk a lot today about interest rates because interest rates have a lot to do with inflation. But let's just get into something I also want to talk about, which is the Chandi trend meter. We've been using the Chandi trend meter now for about 6 months, and I've decided to adopt the indicator. It just makes too much sense. If you're interested in the formula, it involves some calculus, so it's kind of complicated, but be happy to send it to you. Anyway, stocks, you want to see stocks with strong uptrends. And what the Chandi trend meter is, what I like about it is, it's not like a relative trend, it's just the absolute trend. So when you get readings of 90 to 100, that's very strong uptrends, where if you get readings of 0 to 20, those are very strong downtrends. So like take Microsoft here, you can see that the Chandi trend meter has it at a reading in the 90s, looks pretty strong, very strong uptrend. Whereas if you look at Chevron, which is an oil stock, you can see that the Chandi trend meter got down into the 0 to 20 area, which is a very strong downtrend. So the stock's been in a downtrend. It's just a tool. It's a tool that, you should always be aware of trends. And I would never invest in a stock that's in a downtrend. It just doesn't make sense. So let's use the Chandi meter to look at our 5 indexes. You can see here with the NASDAQ, we're back in the green. We're back above the moving averages. NASDAQ is looking better. Here are the mid caps. Mid caps have just moved into the green, moving above the 200-day moving average. I'm seeing improvement here. Here's the New York Stock Exchange moving into the green, moving above the 200-day. It looks like if you get under the hood here and look at these indexes, you're going to see there's a lot of strength coming into the market. There's some buyers coming in. So again, you can use the Chande trend meter. And here we have the S&P 500. So basically, that's 5 out of 5 that are in pretty good shape. Now, if you also note on the power index, interest rates, this is the 5-year Treasury note, really kind of rolling over here. And the power index, which is a rate of change over 125 days, is 22%, where it was up around 45%. So you're seeing a kind of a rollover here of interest rates. Interest rates may have peaked here, and that's the report I showed earlier saying that the Fed's going to hit its target by April. Well, that would be quite good, and we'd see interest rates continue to move lower. Now, if you look at a long-term power index analysis here, I go back to 2004. You can see how dramatic the move was by the Federal Reserve and interest rates around 2020, 2021. So it got up to readings that I've never seen before, like a rate of change of 250%, So you can see here what happened here with the 5-year Treasury. It jumped quite a bit. So this was a shock to the system. This is what's pretty much caused the bear market that we've been going through, which I hope is over. We do feel the bear market is over. Now you can see here 2-year Treasuries coming down. Here's the 5-year Treasury coming down. Here's the 10-year Treasury coming down. It does look like interest rates have peaked, hopefully for the long term. Now, as we get into our 3 economic indicators, again, here's the 10-year Treasury. We've talked about that. Here's the price of oil coming down, so that's less inflation. Here is the financial stocks, which benefit from these interest rates, really starting to get a breakout here. In fact, the banking stocks are looking very much better. Now, I also wanted to point out a pattern here in the aggression index. This is where we're looking at the NASDAQ divided by consumer staples. It's an inverted head and shoulder pattern, which I'm not a big pattern guy, but this is still interesting. You can see here with the aggression index, we came down, made its low in December of last year. We've now kind of consolidated, moving back up again. This is a very positive pattern, especially if we break out above the right shoulder, which actually we've already done. So the aggression index is looking quite promising. So if you have any questions, please let me know. Thank you very much.